How is it now? Better? Can you guys hear me? So I was just talking to myself for the last 2 minutes. Should be better now. Still no audio? Okay. Good? All right. Come on, stop playing games now. People are still saying no sound. Check your check your speakers. It should be working now, right? Okay, better. Works for me. Start again. Okay. What's up, everyone? It's Caddy with Money Investing. So welcome on board for another Market Open live stream. We do have the statement from the European Central Bank coming out in under 15 minutes now at 9:15 a.m. Eastern. And we've also got Christine Lagarde talking in about under an hour at around 9:45 p.m., 30 minutes after the statement comes out. So very much a similar process as with the Fed. Right now, QQQs are down 0.13%. SPY is also lower. We got the Dow Jones pulling back, and the yields, the 10-year yields down over 1%, coming down once again closer to 3.4%. So once again, welcome on board, everybody. Thank you so much for joining. Okay, so sound is good. Looks like I am delayed a little bit. Should be working well. Everything should be good. And I've got a poll going on right now. So ECB, we're going to be talking about it. That is going to be the main topic of discussion. And the reason is because Credit Suisse obviously going through a lot of turbulence. It is pushing higher after we learned that the Swiss National Bank is stepping in with a whopping $53 billion injection into the bank. Not really an injection. They're just lending that money out to Credit Suisse. And, you know, it's kind of crazy because yesterday, Ulrich Kroner, pretty much the CEO, mentioned that we are well capitalized. We don't need the money. We're not, looking for liquidity. And then, of course, 24 hours later, Swiss National Bank steps in to save the day. So it's pushing back up a little bit over 5% pre-market right now. And stocks 600, I believe, are also green at the moment, slightly green. I'm obviously just waiting for what Christine Lagarde has to say about inflation and their fight on inflation with respect to interest rates. I think, it's going to be an interesting conference because it's going to be kind of setting the stage for the Federal Reserve next week. It's going to give us a little bit more insight as to what the Federal Reserve ends up doing because, ECB is going to give us a little bit of a precursor because it's a very similar situation, right? Yesterday, I posted a video, 2 massive decisions coming up, and that's, Christine Lagarde and Jerome Powell, ECB and the Fed, and kind of similar situations. We had the Silicon Valley fallout in the US, and then, of course, Credit Suisse over in Switzerland in part of Europe. So they're in a very similar situation. There's also been European banks dropping pretty aggressively. So it's going to be quite an interesting dynamic with what they end up doing when it comes to... They call it backstop. Okay, wink, wink. Yeah, I mean, Swiss National Bank obviously stepping in quite a bit. So, okay, perfect. Everything's working well. Great. So we're gonna take a look at the report. Again, it's gonna be released over here. This is from February 2nd, 2023. So last month, monetary policy decision. If you read this report, I again mentioned this in my other video. They raised 50 basis points, and they also mentioned that they expect to raise them further. In view of the underlying inflation pressures, the Governing Council intends to raise interest rates by another 50 basis points at its next monetary policy meeting in March. So today is the day. We'll find out in just under 11 minutes whether they raise the rates or not, and if they do, by how much. It's going to be quite interesting, right? Whether they do 25 or 50. It's just a question of who blinks first, right? Is it more of a recession concern? Are they going to be tapping out on their fight for inflation? I personally don't think so. I still believe that they are going to do 50 basis points. But again, we'll find out. And again, the Federal Reserve is next week. It's quite interesting how ECB actually mentions what the plan is for the next meeting, and the Federal Reserve continues to keep it very vague, and they're not providing us with any guidance as to what the next meeting is going to look like. ECB explicitly states that another 50 basis points at its next policy meeting in March. That's the intention, at least, intends to raise by another 50 basis points. So again, we'll find out, what they end up doing. And we've also got, again, Christine Lagarde's conference coming out in now under 40 minutes. We're going to be listening in to that as well. So let's just go over some Economic data for the US. So initial claims came in at around 8:30 a.m. Eastern, 192,000, a little bit lower than what the consensus was. Consensus was 205,000. We were higher last time. So last week we were 212,000, which was much higher than what the consensus was. So again, more people kind of filing for unemployment benefits, unemployment insurance. This week we did drop a little bit from not only the previous week, but also from the consensus. So coming in a little shy of what the expectations were. So 20,000 change, negative change on a week over week basis. Talking about some of the upgrades and downgrades. So we got JP Morgan reiterating Amazon as overweight. We got Bard upgrading Choice Hotels to outperform. UiPath has been upgraded to buy from hold from Canaccord. Stifel upgrades FedEx to buy. We've got Credit Suisse reiterated as overweight from JP Morgan. It's like one bank looking after the other. And then we got, so it's kind of funny how Credit Suisse comes out and gives all these ratings. Like, come on, bro, you got bigger problems to deal with. Focus on yourself, not other companies or other banks when you're rating. Like, literally, Credit Suisse needs to focus on themselves right now. Qualcomm gets an upgrade here. We've got Nike as a sell rating from Redburn, and then Block as a buy from Neutral. Mizuho upgrade, and finally we got Eli Lilly. That's what I've been mentioned. That's what I've been told. That's how you pronounce the stock. The name of the company is Eli Lilly. Is that right? Because I've always mispronounced it.
Eli Lilly.
Okay, perfect. Eli Lilly. So Morgan Stanley reiterates Eli Lilly as overweight. And again, that we've got a trade idea on Eli Lilly, right? So right now, let's take a quick look on how that stock is doing. It is, well, it was up 73 basis points yesterday. It started to move right back up. So very nice reversal opportunity there. And our first target's up to 353 for this company. Meta's pushing higher on the back of the news that UK has also banned TikTok on government devices. Literally came out 20 minutes ago. And Meta's pushing up 1.4% on that news as well. Wells Fargo upgrades Progressive to overweight, and First Republic Bank has outperformed from KBW. And then finally, we got On Holding to outperform from Wedbush as well. So that's going to be the entire roundup here. Let's just take a quick look at some comments. Yeah, First Republic Bank is looking to sell, and they just got an upgrade today. So ECB is behind. They need 50 and does not mean the Fed will do 52. Yep. So I know. That's not the idea. What we're saying is the Federal Reserve and ECB going to blink on this idea that the banks are having this contagion effect and they are starting to pull back? Greg says, who was that? That was Siri. I pretty much had that speech feature where I was just trying to see how you actually pronounce it. So Fed saw 0.25 and pause, and the market will skyrocket near term. So yes, that's one of the things that I believe is possible if the Federal Reserve just 25 basis points, because there's also this counter risk, right? And many people believe that if the Federal Reserve does not do 25 basis points, that could be a bigger risk for sentiment. Not so much for inflation or the economy, but for sentiment, because from what I've learned over the last couple days is that if the Federal Reserve pauses in March, right, next week, then that might send the signal that the Federal Reserve is actually really concerned about the systemic risk related to all these banks' failures, right? Banks falling out. And that could be more detrimental to the sentiment of investors and could cause even bigger harm. And as a result, they need to and should actually do 25 basis points. What happens after, of course, is anybody's guess. We're going to find out what Jerome Powell says. But at the same time, when I went over the change, the big flip that's happened in the last 6 days and 8 days, it's quite crazy how significant of a dovish pivot we have seen in the Fed funds futures. The terminal rate, was at 6%. And what's interesting? Jeremy Siegel pointed this out, that this meeting next week on March 22nd, we're going to get the summary of economic projections, the SEP. And one of the most important things in the SEP is a dot plot. Right, the dot plot is pretty much all the FOMC members kind of mentioning where they see the terminal rate to be. Like they're projecting out what the rates are going to be in 2023, 2024, and 2025 and longer term. And that already gets submitted in 2 weeks prior to the FOMC meeting. So hopefully they'll be able to make those changes. That's quite interesting, because if we just had the banking crisis literally less than a week ago, then then they definitely need to make those assumptions, because 2 weeks ago the Fed funds futures was pointing to a terminal rate of 6%. Now we're barely getting up to 5%. So that's been a big dovish pivot from the Fed funds futures. And yet the market's non-reactive to that pivot, right? So it's been a quite interesting dynamic with the markets, with macros and of course fundamentals tied in, and everything that has to do with interest rates and inflation as well. So it's been quite an interesting past few weeks. So Ankur, what's going on with banks, Caddy, and what do you think will happen in the near future? So we've already covered a lot of the reports that have been coming out. So I've given out a lot of videos and updates going over what's going on with the banks. But really, I mean, I'm looking at SIB, systemically important banks. That's something that I have mentioned in my yesterday's video as well, that I do think that some of the larger banks, as they are seeing significant deposits, right, it's billions of dollars in deposits, do represent an opportunity because they can put that deposit to better use. And they're well capitalized. I think Steve Eisman was his name, the big short investor from back in 07, 08, mentioned that this is literally the banking sector, especially the larger institutions, big banks are the most, they're well capitalized, the best capitalized what they've ever seen in their lifetime. In other words, banks do have the reserve ratios and they have a lot of deposits and they're healthy, in other words. So I do still believe there's potential in some of the bigger banks, especially when you look at JP Morgan, Bank of America, Citi, and then, Wells Fargo. Wells Fargo's got its own problems with the scandals and everything, but I do like JPM and BSC from that standpoint. But I'm also looking at XLF as a more diverse, ETF, because it's also got Berkshire Hathaway. It's also got some of the other larger institutions as well. So yes, 4 minutes for the ECB statement to be coming out. We'll kind of take a look, and the first thing is obviously going to be how much do they raise the rates by. We'll quickly read through the statement and what the next policy meeting, what the expectations will be for interest rates. So again, this was from February 2nd, 2023, the last ECB meeting. They pretty much told us they were going to raise rates by another 50 basis points at the next policy meeting in March. And again, we'll find out, if that actually happens or not. And they said keeping interest rates at restricted levels will over time reduce inflation by dampening demand and will also guard against the risk of persistent upward shift in inflation expectations. In any event, the Governing Council's future policy rate decisions will continue to be data dependent and follow the meeting by meeting approach. So again, a lot has happened since February and March. Of course, February, the markets were also lower. I'm not sure if Stock 600 dropped in February or not. I'm pretty sure they did, but let's take a quick look. So in the month of February, they were actually higher, 1.74% higher, but March, they're absolutely getting destroyed, down 5.2%. S&P in the month of March is down almost 2%, and the NASDAQ here is flat. Not really doing that worse off. I mean, it's only down 19 basis points at the moment for the month of March. All right, so we're going to end the poll here. Make sure that you do vote if you haven't already. We got a couple more minutes left. And what do you think is going to happen with ECB? And are they going to raise rates by 25, 50, or pause or cut rates? We actually do have 3% people expecting the ECB to cut rates. That is quite crazy if you think about it, because again, 250 votes, we've got 3 people, that's 7.5 people. Who are those 7.5 people expecting ECB to cut rates? Show yourself. No, I'm just kidding. We'll keep it anonymous, but that's quite crazy. People expecting ECB to cut rates here. But yeah, 49%, 25 basis points. That's a little bit of a step down from what they guided for, 50, and that's a fair assumption to make considering what's transpired over the last week or so. But again, we'll see how the markets react to it. So I've got the QQQs here. I'll put the stocks 600 down below just to see how the markets over in Europe kind of react to that news. And then we'll put the SPY up top left, and we'll put the 10-year yields, which are still down 1%, over here. I've been trying to like lose track of days. It's crazy because I thought today was like Wednesday or something, but no, it's Thursday. So it's been such a busy couple weeks, as I'm sure you guys can imagine. But dream big. Kevin says, yeah, dream big. Well, hopefully for next week we'll be dreaming big, and we'll see what happens. Whether it's going to be a rude awakening or a precise prediction, we'll find out. I think it's going to be very much about the tone. They might still do 25, but I kind of like the idea that Jeremy Siegel also suggested that Jerome Powell might use a bit of a dovish tone, suggesting a potential pause. They might not commit to it, but it's possible that they actually end up saying something that resonates with a little bit of a pause sort of structure. So anyway, we are seeing markets come down a little bit. Stock 600 rolling over. All right, let's just read through this. March 16th, here it is. Let's see. So I'm going to quickly search for basis points. I don't know why this is not loading up. Maybe there's too many people on this website right now, but all right, let's see what's going on. Open up. Okay. So we are seeing stock 600 down 30 basis points. Yields are stabilizing a little bit, and stocks over in the US also rolling over just a little bit. All right, finally. Oh my God. All right, there we go. So let's just take a quick look. So, okay. Decided to increase the ECB rates by 50 basis points in line with its determination to ensure a timely return to inflation to 2%. So that's a pretty bold statement from the ECB here. And the Governing Council is monitoring current market tensions closely and stands ready to respond as necessary to preserve price stability and financial stability in the euro area. And let's see if they have any potential for the future. So ECB staff now sees inflation averaging 5.3% in 2023, 2.9% in 2024, and 2.1% in 2025. At the same time, underlying price pressures remain strong. Inflation excluding energy and food, so core CPI, continued to increase in February, and ECB staff expects it to average around 4.6% in 2023. And December projection, subsequently, it is projected to come down 2.5% and then 2.2% in 2025. So yeah, they've raised it by 50 basis points. Now their marginal lending facility rate has been increased to 3.75%, refinancing operation rate 3.5%, and deposit facility at 3%, and will take effect from March 22nd. Do we have anything with respect to the next meeting? No, I don't see anything here yet. But the markets are stock 600 still down 19 basis points, more or less flat. We're not seeing a big sized move. But SPY is down about 0.5%, and the QQQs are down 20 basis points as well. So not a pretty substantial move, and Credit Suisse here pre-market still up 5% at the moment. Again, we'll listen in on what Christine Lagarde has to say now in under 30 minutes. So we'll listen in on the press conference as well, and what she has to say. But yeah, pretty bold statement there. 50 basis points going the full 50, quite aggressive there. But they definitely have an inflation that is much higher than that in the U.S. So I think they are, and they're also further behind with respect to raising interest rates to begin with. So, but crude oil down now under $67. I actually did a video. Make sure that you do check that out. I posted that 30 minutes ago. Very, very important video going over a potential opportunity in the markets that you can take advantage of and do some more research in. So we talked about it in that video. But yes, it's coming down. $65 per barrel is going to be that next support. And volatility is once again on the move, up over 2.4% at the moment. And again, yields rolling over right now. So Dio says, no, it is bearish because the market has been betting on quick and lots of QE really soon. And that's a good point to bring up because, you know, in my other video, that's literally what we talked about, because the market is no doubt playing with fire right now. And the reason why I call it playing with fire is because folks, we're pricing in. If you just understand what the market is pricing in right now is crazy. It's maddening how we are expecting 1, 2, 3, 4 rate cuts in 2023. That's how many rate cuts we're pricing in from the Federal Reserve, starting as early as June. And then overall, the market's pricing in 1, 2, 3, 4, 5 total rate cuts priced in already. That's what the Fed Funds Futures expecting. And the rates to end at around 4% by the end of this year. 4%. We're barely getting up to 5%, and the expectation is 4% by the end of this year. This is, a very, very thin line between being right or being aggressively wrong. So, I mean, if that happens, great. Market's going to find themselves a nice footing. We could see some upwards momentum, especially in the short term. Of course, a lot of it will depend where inflation ends up, later down the road. But I really doubt we're going to see 4 cuts this year. What do you guys think? Like, I want to hear from you. Let's just see. I don't know what the question should be. Are the Federal Reserve actually going to cut? Or if so, how many cuts can we expect in 2023? Like, what is going to be that poll? I don't even know what the question will be. So let's just go with the assumption that the Federal Reserve will most likely pause and start cutting later this year. Let's just ask a simple question. How many cuts do you expect Powell to do? Or let's just do the Fed. Expect the Fed to do under the, this is assuming they pause and start cutting. Okay? So I'll just do 1, 2, 3, 4. All right, so 4 is what the market's pricing in right now. I'll actually do 0 as well. 0 cuts, meaning that we stay flat. So 1 to 2. I'll do 3 and then 4. So yeah, let me know. But again, this is, market's kind of built on that assumption that we are seeing a lot of QE coming right back in, because rate cuts are, and again, this is not really an active stance of quantitative easing. Sure, you can kind of spin it that way, but we are coming off of some extreme levels, some very restrictive levels. So I think that's going to be quite interesting whether, market expectations and a lot of the monetary policy effects have not really been seen. They are now starting to show up, right? Unemployment starting to go up, retail sales contracting. January was a little bit of an uptick, but we once again saw a contraction here in February. And then, of course, the bank contagion, it is very normal to see those things happen, and they will happen more and more as we get more, restrictive levels and as higher interest rates we see in the U.S. So I feel like it's only the beginning. If we continue to see rate hikes, it's going to happen, but it's going to be very much in line with what Jerome Powell has also been talking about: economic pain, premature loosening policy, making sure that inflation comes down to the target of 2%. And it's like towards the end, right? Getting down from 6 to 2 is far more difficult than getting down from 10 to 6 or 9 to 6, right? The early gains are going to come off, but getting down from now 6 to 2 is going to be far more challenging. Of course, they'll have to crush a lot of things. 2023, we're talking about 2023. That's what the market's pricing in. Market's pricing in at least 3 to 4 cuts in 2023, right? 1, 2, 3. And then, so market's pricing in 3 cuts right now and then 2 more in 2024. So that's what we're asking in 2023. Howard says, why be aggressive with 50 basis points in March only to reduce 2 months later? Doesn't make any sense. So right now, I don't think they're pricing in 50 though. They're pricing in 25. That's what the market's pricing in. That's what I also expect. Like, Federal Reserve is not going to do 50 this March. That would be crazy. That would really just, crush the markets. I think what they're planning to do is 25 basis points next week. And then the dot plot is going to be quite interesting, right? What the expectations are. We're going to take a look at the SCP and interest rate projections. It's kind of crazy because just a day before the Silicon Valley Bank failed, Powell mentioned that it's going to be higher than what we previously anticipated, right? So if you go over to the Federal Reserve website and we go over to monetary policy, meeting and calendars, the last SCP was released in December, I believe. So January, we didn't have anything, January, Feb. The last SCP was back in December 13th and 14th. Projection materials, and they mentioned that interest rates in 2023 will be as high as 5.1%. 5.1% is what they mentioned back in December. And then in March, literally at the U.S. Senate and House Financial Services Committee, his testimony, he said rates are going to go higher than what we previously anticipated. So previous anticipation, 5.1. They're going to go higher than what they previously anticipated. So let's just call it 5.5, 5.2. And just one day later, everything starts to go south and the market starts expecting QE, and we're barely getting up to 5%. Crazy. Absolutely wild. So 47% zero. So see, right now, and I feel like we're on the same page. Only 9%, 15% folks expecting 3 to 4 cuts, but majority, 70, I would say like 85%, expecting no cuts to as many as 1 to 2. So yeah, Chris says this coming recession is the most anticipated in history. This gives everyone the time to prepare for it. This forestalling major recession. Yeah, this is one of the most anticipated recessions, right? It's pretty crazy to think about that. But anyway, so we do have, again, Christine Lagarde in 19 minutes here, 7:45 p.m. for me is when she's going to start talking. So we'll listen on her, but we got about 4 minutes till market opens. So we got the S&P, the NASDAQ over here, the Dow. The yields are coming down, which is good, 3.4%. So TMF is on a strong day here, 3.6% pushing up, and TLT is up over 1.27%. So a little bit of momentum coming back in for bond prices. So bond ETS and yields really coming down at the moment. All right. So what could be said in the conference that could tip the U.S. market? Tip as in like tip to the downside, like really start aggressively selling off, or like some insight as to what we can get from what Jerome Powell could say next week. Is that what kind of connection are we making here? So Stefan, you're saying no sound. Maybe check your speaker because everybody else is getting sound. We were having that issue earlier, but I think it's working now. Yeah, future expectations of ECB rates, that will certainly move markets because, you know, now that we're so intertwined, I mean, European markets and the US markets and of course Asia, every place, there's just so much trade-off that if ECB continues to tighten, even though the Federal Reserve is starting to pause a little bit, there's going to be somewhat of a disconnect in monetary policy, even though they need to get a little bit higher, right? US rates are still going to be much higher than that in Europe. But there's still going to be that disconnect that ECB is still tightening conditions while the Federal Reserve is already past that and they're now starting to pause maybe. So impact of TikTok ban today. Yep, so we talked about it earlier. Meta's pushing higher, 1.5% last time I checked. So it is green at the moment. Now only up 0.5%. So giving up on some of those gains after the ECB report came out. Tesla here is flat. We've got Google flat, Apple's down, and we got Microsoft slightly pulling back as well, with volatility still up quite a bit. And crude oil really is selling off down 2%. Bitcoin just under 25,000, Ethereum a little bit under 1,700, just also consolidating sideways after having a very strong rally in the last couple of days. So, Dio, none of your business, says inflation has been crazy sticky in the U.S. Economy has been crazy resilient. What we are going to see, long and drawn out recession, low growth period to kill inflation. It's certainly going to take a bit of more of an economic pain in order to get inflation back down. We're certainly seeing some good improvement, no doubt. I mean, PPI numbers came out good. CPI numbers have been coming out good, but it might take a little bit more than what we already have to get inflation back down. Now, that doesn't necessarily mean just to keep raising rates. I've always been a little bit more of the supply side of the equation, and I know it takes many years to do that. But I've always been of the idea that instead of just kind of lowering your demand every time you get an inflation problem by raising rates, why not really focus on increasing supply, right? Why not increase productivity, increase supply in a way that we get better balances in the future between those two things. So Naman, can you talk about Adobe? So yeah, what do you want to know about Adobe? We've talked about it at length in another one of my videos. Adobe did report their numbers, so they are higher. I think last time I checked, yep, it's 3% green. Beat on EPS, beat on revenue. I will be doing a video on them very, very soon, but looks like they are gapping up a little bit right now. So anyway, we've got the Dow open. Yields are still rolling over, 3.4 for the 10-year. I'll actually reload this chart so we have a good understanding on all yields. The 10-year. All right here. So 10-year yields, once again, back under a little bit close to 3.4%. 3-month is slightly pushing higher. 1 year is almost at 4.3. 6 months are getting a bit of a reversal back up. But 10 years is really falling apart right now. And as a result, the spread is down a little bit under 47, close to 48 basis points. Then talking about the markets here, NASDAQ is slightly lower. We've got the S&P down about 0.5%, and the Dow Jones is down about 49 basis points as well. Dollar index is just a little bit over 104.5. Yeah, markets open. Ding, ding, ding. So any update on sector rotation? So again, yesterday was quite interesting. What we really saw was a bit of a risk-off environment. Bond yields coming down, as a result, prices going higher. So there was demand for bonds. Big tech, there was demand for big tech as well because yesterday we had Meta, Google, more of the comm services, consumer discretionary, and a little bit of big tech, Microsoft, Apple, I think were green as well. Semis, not so much. Some of the more riskier growth stocks, not so much. Energy dropped, financials dropped for their own reasons, but it was more of a risk-off environment yesterday in the markets as well. Another really interesting report that I read today was about this idea that the price earnings multiple on the S&P 500 on an aggregate basis, sitting at roughly 17.5 times. Now that's all, nice and good, but profit margins for a lot of companies have been declining. So that's another thing, right? If people don't spend as much money because of potential recession fears, and margins also start declining for companies, then all of a sudden you've got a denominator, which is the earnings per share, all of a sudden starts to become a little bit more on the expensive side, right? You've got a lower earnings, lower denominator, same price on the numerator, and you've got a much higher price earnings multiple. And that would force us to recalibrate a little bit lower to better levels. So Chris, is tech becoming a safe haven now after the big fall in 2022? Well, one can argue the valuations are certainly cheap. If you got that valuation support in big tech, and then you've also got a support in terms of the amount of cash these companies have, cash-rich companies. Banking definitely under a lot of stress, under a lot of pressure. Energy under a lot of pressure. If you think about sector by sector, right? Banks under a lot of pressure with everything that's going on, right? With the systemic risk. Energy, well, crude oil prices have been coming down, as a result, taking down all the energy stocks with them. So if you take a look at energy watch list, everything's red because crude oil prices have been just selling off. Then if you compare that to, let's say, utilities and staples, they're more of a safe haven type sector to begin with in terms of recession. However, I do think the valuation is a little too high for staples. We've talked about this before, right? Walmart and Costco and a lot of these companies trading at crazy valuations, crazy levels, worth even more on a price to earnings, price sales basis than something compared to like a Meta or a Google, right? For example. So yes, from a value perspective and companies that have the potential to kind of survive these types of environments, considering that they're cash rich, big tech starts to become very attractive. And of course, considering that we're towards the tail end of the hike cycle, right? Interest rate hike cycle. Now, would I clump all these big techs together? Maybe not, right? There's some better than the other in terms of the value that they bring and the price at which they're trading at. But yes, collectively, I think they do serve as a better proposition compared to some of the other sectors out there. So Oleg, agree tech is safe haven, but focus on small tech caps with low debt. So that's another thing that I learned. There was a report, I forgot who posted that. There was a bank that posted a report that talked about Russell 2000, which I believe is a small cap. I got to take a look here. Small cap index. I believe it was Russell 2000 or Russell 1000. But what it really mentioned was that in the Russell 2000, 45% of the Russell 2000. Again, don't quote me whether it's Russell 2000 or 1000. Whichever one's a small cap. Can't remember. Okay, so the Russell 2000, yep. So index is a small cap US stock market index, smallest 2,000 stocks in the Russell 3000. So Russell 2000, the analysis was, or the report was, that 45% of stocks in the Russell 2000 are not profitable. And you know what's even interesting? Almost half in that report, they suggested 50%. I was going to do a video about this, but 50% of the Russell 2000 companies actually have debt that has a floating rate attached to it, meaning if interest rates continue to go higher, they're going to be subject to a higher interest expense because their rate on their debt obligations also going to be going higher. It's not fixed, it's floating. So that was quite interesting as well. Kind of puts things a little bit into perspective. Small cap may not be as safe, considered that they are, one, not super profitable, obviously, and they are also holding on to debt, which might be on a more floating rate because you're not getting the best deals, right? Of course, the biggest companies are getting the best terms when you go through these large institutions. If you're a startup, if you are a small cap, you're not getting the best deals. Yep, so Chris says tech valuations are most attractive right now. So fully do agree, considering the growth, when you price in the expected growth 4, 5, 10 years out, they definitely do sound very appealing at the moment. XLK. There's another, very, very interesting place you can actually check out the valuations. So let's just go over to the groups, and we'll go over industry. No, we'll go over sector. We'll go over valuation. There we go. So yeah, so technology collectively right now, 28 times. Forward, we're trading at 20, which quite reasonable. Then if you compare that to consumer defensive, right? So something that I mentioned earlier, defensives includes your staples. They're almost trading at the same price earnings multiple as tech at 20, 23 on a trailing basis. Then we got utilities trading at 22, but forward just crazy low. We might have to do more research on that, why that is. And energy here, 7.669, because again, earnings are expected to be incredibly high, 6.24 on a trailing basis. Then we got consumer cyclicals, 19.65, and comm services, which includes your Googles and your Metas, 15.2. So quite decent multiple for them as well. All right, so we got another few more minutes, 7 minutes till ECB Christine Lagarde is gonna take over. So we'll listen to her and what she has to say. So we're going to end the poll here. 46%, majority of people expecting the Federal Reserve to do nothing, just pause after the rate hike. And then 39% expecting at least 1 to 2 cuts in 2023. So we'll find out what Powell has to do and say next week. Guys, make sure that you drop a like. I would really appreciate it. Average view duration, 11 minutes and 11 seconds. That's a crazy number. Anyway, make sure that you drop a like. Right now we're only at 99 with over 500 people watching, so hopefully I can earn your like throughout this stream. But thoughts on FRC? So First Republic Bank, right now down 32%, incredibly oversold. I would kind of, stay away from, some of the more smaller regional banks because, you just never know. You can get a dead cat bounce. You can get a bit of a, move back up. Like, for example, had you, timed the bottom perfectly at $17, it was already up like 102%. So it is incredibly volatile. All I'm going to say is just be careful. When it comes to banks, and the only play that I'm looking at is some of the larger institutions I've already mentioned, XLF, EFH, that's also Vanguard Financials ETF. They're more sort of like, larger institutions and SIBs, right? Systemically important banks. And FAS would be on the list, but it's also leveraged. So definitely be careful with that one as well. But that's all I'm not going to be going after individual banks because again, they've got that risk. Gave you that 100 like. Thank you so much. I really appreciate it. Pause could be damaging to the economy. It's possible. I mean, inflation can certainly spiral out of control if the Federal Reserve goes too hard on their quantitative. It's just for the last couple years, it's been just like a pendulum swinging back and forth. The Federal Reserve was too soft, too much QE, and now they're like too tight, too much QT. And then imagine if something breaks and then now once again start cutting. Too much QE, inflation spirals back out of control, and they just keep going back and forth. There's like it's like in a cartoon. Inflation's running, the Jerome Powell is just running behind it, and they're just like running in circles. So they have to stick to something. They have to stick to a policy and then just go for it. I mean, eventually inflation can and will come down if they just stick with it. And there might be, of course, short-term pain in the economy, but history suggests that is one way to bring inflation down, is through absolutely crush economic demand. Yeah, Meta crossing over $200. That is incredible. Up 1% here on the day. AMD is pushing higher. Google, Amazon also green. So if you go through the list here, Snapchat, Adobe on earnings pushing higher. We got CPRX, Square pushing higher. Foot Locker, Qualcomm, Twilio, Crowd. So we don't have like a lot of green, but so far it's kind of been like a decent enough day. How's TMF doing? Our lovely TMF up 3% only. It's not up as much. Yields are down over 1.3%. I'd expected more. And again, 10-year yields. You can also look at the 20-year. Yeah, we should actually be looking at the 20-year. They're down, yeah, 0.5%. So again, TMF is kind of levered on the 20-year treasuries, and same thing with TLT. It's levered on the 20+ year treasury bond. So they're long duration, right? My bet is not on short-term yields, because again, the shortest one you can see is the Federal Reserve. That's the overnight rate, and then you've got the 4-week and 13-week and 26 weeks, and again, 3 month, 6 month translating over. So my bet really is that eventually yields are going to roll over for longer duration bonds. So, and that's why again, US 20 years only down about 42 basis points right now. Look at NVIDIA. Do I really want to? Should we even really look at NVIDIA? Oh man, if it's green today. Okay, slightly down, 0.73%, but $240. Market cap now at almost $600 billion for the company. Last year's revenue, $27 billion. So we've got 600 divided by 27. We've got 22 times sales. That's great. That is fantastic. And yeah, continues to do really, really well. Yeah, UiPath got an upgrade today. I don't know if they reported earnings though. Maybe they did. I think they did. Yeah, so they reported, I think, last night. Beat on EPS, beat on revenue. Very strong number coming in. So pushing up. Let's just quickly take a look at their earnings right here. So fiscal 2024 guidance, that's actually really good. They provided the full year guidance here. They're expecting $1.25 to $1.26 billion in revenue. They didn't provide an earnings estimate, but they did beat on EPS 15 cents per share, up from 5 cents. It's 200% growth. Consensus 7 cents. It's 100% beat. Revenue came in at 308 million versus 278. So we got a double beat here, and the guidance also coming in strong. So if you take 1.25 billion, market cap's at 10. We are, for UiPath, trading at 8 times sales. It's actually not bad. Not bad at all. It's pretty decent. All right, so about a minute left. I'll do an audio check, as always. Just give me a thumbs up if everything works well. What I'll do is I'll keep the SPY over here. And then, let's see. I'll put the S&P 500 over here, the 5-minute chart. And then I'll put the stocks 600 over here for Europe. And of course, we'll have the 10-year yields down here at the bottom left, right behind my face. UiPath, I think it's a pretty big holding. You can take a look if you want. So let's see, ARK ETFs. All right, so I think it's in the main fund. Holdings. So UiPath is about 5.32% in their main fund. I'm sure they've got other funds where they have UiPath, but 5.3%. Zoom, surprisingly, has always been their biggest position. I've always been curious to learn about why they believe Zoom to be like this company that they believe is going to just like, be disruptive. All right, I'm going to do an audio check. I don't want to do it for the music. As soon as they come on, I will be doing an audio check. Just give me a thumbs up in live chat if everything's working well, and we should be all set. So Stock 600 has recovered a little bit. It's up 13 basis points right now after the report that's come out. And S&P 500 still down 33 basis points. And we'll put the NASDAQ here down still 22 basis points. So I just want to see something. Okay, so usually like 7 to 8 minutes more, because I'm just looking at the last press conference. I'm looking at how long after they were at this screen they started the conference. Like I would say like 10 minutes. Give it another 10 minutes before they actually begin the press conference here. Please look into PHYS. All right, let's take a look at that for you, Tristan. So, all right, what do we got here? Spot Physical Gold Trust. Okay, so gold ETF, $5 billion. Again, it's probably going to be trading on gold prices. It's almost an identical pattern, almost an identical chart. So again, you can see this and you can see this, right? It's a little bit different, but the volumes seems a little bit dodgy. But overall, I mean, if you are looking at is this like a miner? No, it's an investment trust. So if you are really looking at gold, you could simply get like a gold ETF. You could get like a lot of different types of gold ETFs that you can benefit from. So it operates as a closed-end investment trust, which engages in investing and holding all of its assets in physical gold bullion. So I'm sure there's lots of other gold ETFs that you can find. This is the miners ETF, Van Eck Gold Miners, pretty popular, pays you a dividend as well. But I'm sure you can find Vanguard Gold ETFs like this right here is also another one, 2.4% dividend yield. And it's simply, another engages in production and sale of gold, copper related activities. It's always been more beneficial to actually hold a miner as opposed to actual physical gold or just a gold ETF because they also pay you dividends, right? Miners pay you dividends. It's always been the saying, right? I mean, would you rather buy the gold or buy the company that sells the shovels to actually mine gold, right? Or the miners that actually mine gold. So, all right, let's begin. All right, so again, I'm going to do an audio check. Let me know if you guys can hear this. And I just want to make sure that I do it at the right minute because I don't want this copyright strike because of the music that's playing.
Good afternoon and welcome to our press conference. I'm joined on stage by President Lagarde and Vice President de Guindos. My name is Wolfgang Preußel. As we are connected via video to some who are connected on screen, I would like to ask you to turn on your camera and your microphones if you ask questions later on. And with that, I give the floor to President Lagarde.
Thank you very much. So good afternoon. The Vice President and I welcome you to our press conference. Inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase the three key ECB interest rates by 50 basis points in line with our determination to ensure the timely return of inflation to our 2% medium-term target. The elevated level of uncertainty reinforces the importance of a data-dependent approach to our policy rate decisions, which will be determined by our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are monitoring current market tensions closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area. The euro area banking sector is resilient with strong capital and liquidity positions. In any case, our policy toolkit is fully equipped to provide liquidity support to the euro area financial system if needed, and to preserve the smooth transmission of monetary policy. The new ECB staff macroeconomic projections were finalized in early March, before the recent emergence of financial market tensions. As such, these tensions imply additional uncertainty around the baseline assessments of inflation and growth. Prior to these latest developments, the baseline path for headline inflation had already been revised down, mainly owing to a smaller contribution from energy prices than previously expected. ECB staff now sees inflation averaging 5.3% in 23, 2.9% in 24, and 2.1% in 25. At the same time, underlying price pressures remain strong. Inflation, excluding energy and food, continued to increase in February, and ECB staff expects it to average 4.6% in 23, which is higher than foreseen in the December projections. Subsequently, it is projected to come down to 2.5% in 24 and 2.2% in 25, as the upward pressures from past supply shocks and the reopening of the economy fade out, and as tighter monetary policy increasingly dampens demand. The baseline projections for growth in 23 have been revised up to an average of 1% as a result of both the decline in energy prices and the economy's greater resilience to the challenging international environment. ECB staff then expect growth to pick up further to 1.6% in both 24 and 25, underpinned by a robust labour market, improving confidence, and a recovery in real incomes. At the same time, the pickup in growth in 24 and 25 is weaker than projected in December, owing to the tightening of monetary policy. The decisions taken today are set out in a press release that is available on our website. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Turning to the economic activity first. The euro area economy stagnated in the fourth quarter of 22, thus avoiding the previously expected contraction. However, private domestic demand fell sharply. High inflation, prevailing uncertainties, and tighter financing conditions dented private consumption and investment, which fell by 0.9% and 3.6% respectively. Under the baseline, the economy looks set to recover over the coming quarters. Industrial production should pick up as supply conditions improve further, confidence continues to recover, and firms work off large order backlogs. Rising wages and falling energy prices will partly offset the loss of purchasing power that many households are experiencing as a result of high inflation. This, in turn, will support consumer spending. Moreover, the labor market remains strong, despite the weakening of economic activity. Employment grew by 0.3% in the fourth quarter of 22, and the unemployment rate stayed at its historical low of 6.6% in January 23. Government measures to shield the economy from the impact of high energy prices should be temporary, targeted, and tailored to preserving incentives to consume less energy. As energy prices fall and risks around the energy supply recede, it is important to start rolling back these measures promptly and in a concerted manner. Measures falling short of these principles are likely to drive up medium-term inflation pressures, which would call for a stronger monetary policy response. Moreover, in line with the EU's economic governance framework, and as stated in the European Commission's guidance of March 8, 23, fiscal policies should be oriented towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can help reduce price pressures in the medium term. To that end, governments should swiftly implement their investment and structural reform plans under the Next Generation EU programme. The reform of the EU's economic governance framework should be concluded rapidly. Let's look at inflation. Inflation edged down to 8.5% in February. The decline resulted from a renewed sharp drop in energy prices. By contrast, food price inflation increased further to 15%, with the past surge in the cost of energy and of other inputs for food production still feeding through to consumer prices. Moreover, underlying price pressures remain strong. Inflation excluding energy and food increased to 5.6% in February, and other indicators of underlying inflation have also stayed high. Non-energy industrial goods inflation rose to 6.8% in February, mainly reflecting the delayed effects of past supply bottlenecks and high energy prices. Services inflation, which rose to 4.8% in February, is also still being driven by the gradual pass-through of past energy cost increases, pent-up demand from the reopening of the economy, and rising wages. Wage pressures have strengthened on the back of robust labor markets and employees aiming to recoup some of the purchasing power lost owing to high inflation. Moreover, many firms were able to raise their profit margins in sectors faced with constrained supply and resurgent demand. At the same time, most measures of longer-term inflation expectations currently stand at around 2%, although they warrant continued monitoring, especially in light of recent volatility in market-based inflation expectations. Moving to the risk assessment now. Risks to the outlook for economic growth are tilted to the downside. Persistently elevated financial market tensions could tighten broader credit conditions more strongly than expected and dampen confidence. Russia's unjustified war against Ukraine and its people continues to be a significant downside risk to the economy and could again push up the cost of energy and food. There could also be an additional drag on euro area growth if the world economy weakened more sharply than expected. However, companies could adapt more quickly to the challenging international environment, and together with the fading out of the energy shock, this could support higher growth than currently expected. The upside risks to inflation include existing pipeline pressures that could still send retail prices even higher than expected in the near term. domestic factors, such as a persistent rise in inflation expectations above our target or higher than anticipated increases in wages and profit margins, could drive inflation higher, including over the medium term. Moreover, a stronger than expected economic rebound in China could give a fresh boost to commodity prices and foreign demand. The downside risks to inflation include persistently elevated financial market tensions that could accelerate disinflation. In addition, falling energy prices could translate into reduced pressure from underlying inflation and wages. A weakening of demand, including owing to a stronger deceleration of bank credit or a stronger than projected transmission of monetary policy, would also contribute to lower price pressures than currently anticipated, especially over the medium term. So let's look at financial and market conditions. Market interest rates rose considerably in the weeks following our last meeting, but the increase has strongly reversed over recent days in a context of severe financial market tensions. Bank credit to euro area firms has become more expensive. Credit to firms has weakened further, owing to lower demand and tighter credit supply conditions. Household borrowing has become more expensive as well, especially owing to higher mortgage rates. This rise in borrowing costs and the resultant decline in demand, along with tighter credit standards, have led to a further slowdown in the growth of loans to households. And these weaker loan dynamics, money growth has slowed sharply, driven by its most liquid component. So summing up, inflation is projected to remain too high for too long. Therefore, the Governing Council today decided to increase the three key ECB interest rates by 50 basis points, in line with our determination to ensure the timely return of inflation to our 2% medium-term target. The elevated level of uncertainty reinforces the importance of a data-dependent approach to our policy rate decisions, which will be determined by our assessment of inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are monitoring current market tensions closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We now stand ready to take your questions.
Thank you, President Lagarde. And the first question goes to Alex Weber of Bloomberg News. Alex, please.
Thank you. Good afternoon. I was wondering, could you explain a little bit how you see the path for interest rates ahead? I mean, until a few days ago, it seemed pretty clear that interest rates would have to rise further after this meeting, but you didn't give any guidance in the statement. Does this mean it could be that we've already reached the peak in interest rates? And then secondly, regarding the banking sector more broadly, a lot of people have drawn parallels to between what happened at Credit Suisse and Silicon Valley Bank and failures we've seen at the last financial crisis like Bear Stearns. Do you see any risks that we're on the verge of a systemic crisis like in 2008?
Thank you very much for your question. On your first question, I would call your attention to one particular paragraph, which is the first one in our monetary policy statement, in which we are really trying to dissect for you the mechanism of our reaction function. And this is really the best guidance that we can provide. And it is, number one, the assessment of the inflation outlook in light of the incoming economic and financial data. Number two, the dynamics of underlying inflation. And number three, the strength of our monetary policy transmission. So that's brand new. These three components, we never discussed them, we never let them out, and they are clearly identified as the three elements that will be taken into account to determine our reaction function going forward. Second point, if our baseline was to persist, when the uncertainty reduces, we know that we have a lot more ground to cover, okay? But it's a big caveat. If our baseline was to persist, as you know, the projection that were decided by staff, sorry, not decided, but determined by staff, are based on data and assessment of the situation with a cutoff date. And that cutoff date was February 15th for the international outlook and technical assumptions, and March 1st for the euro area macroeconomic projections. Now, since March the 1st, a lot obviously has developed. And the projections that we have do not incorporate any of the most recent development, and certainly not the impact of the most recent financial tensions that we have observed on the markets. So there is a level of uncertainty that has been completely elevated as a result of that. And that is the reason why we reinforce the principle of data dependency that we have indicated in the past, with a clear map of the reaction function that we will have in the future. So it is not possible at this point in time, and on the basis of the first component that I have mentioned, which is assessment of the inflation outlook in light of the incoming economic and financial data, it is not possible to determine at this point in time, what the path will be going forward. But we know that it will be data dependent, and we know that if the baseline as we have it was confirmed and was to persist, we would have more ground to cover. On your second point, I will again read for you one more time what is in the second paragraph this time of our monetary policy statement, which is that we are monitoring current market tensions closely. We stand ready to respond as necessary to preserve price stability and financial stability in the euro area. And given the reforms that have taken place, and I was around in 2008, so I have clear recollection of what happened and what we had to do. We did reform the framework. We did agree on Basel III. We did increase the capital ratio. We did increase the financial coverage ratio as well. And I think that the banking sector is currently in a much, much stronger position than where it was back in 2008. Added to which, if it was needed, we do have the tools, we do have the facilities that are available, and we also have a toolbox that has other instruments that we always stand ready to activate if and when needed. And finally, and that's a tribute to our staff, because as you can imagine, we all have worked quite hard in the last few days, and particularly the last few hours. They have demonstrated in the past that they can also exercise creativity in very short order in case it is needed to respond to what would be a liquidity crisis if there was such a thing. But this is not what we are seeing. Thank you.
Thank you, President Lagarde. And the next question goes to, I'm now turning to remote participants, to Balazs Koranyi of Reuters. Balazs, please, over to you.
Good afternoon, and thank you for taking my questions. President Lagarde, could you unpack for me what you mean a lot more ground to cover?
Sorry, I missed the first part of your question. Balazs, can you repeat the first part? I missed it.
Yes. I said, could you please unpack for me your statement that there might be a lot more ground to cover should the baseline prevail? What does that mean? Especially given that prior to this meeting, almost all governing council members, including Philip Lane, has said that more rate hikes will likely be needed beyond March. So are you walking back on that commitment, or is the ECB's inflation fighting stamina waning? Are you giving up on inflation? The second question I have is the usual one. I'm sorry. What other options were being discussed in the meeting today? What were the alternatives that policymakers were supporting?
Thank you for your question. We are not waning on our commitment to fight inflation, and we are determined to return inflation back to 2% target in the medium term. That should not be doubted. The determination is intact, and the path at which we will cover the ground, the pace that we will take, will be entirely data dependent. That's what we have always said. And we are saying on this specific occasion that given the level of uncertainty that has been significantly increased as a result of the most recent financial tensions and development, given that level of uncertainty, it is better to make the decision that we believe is a robust decision with our 50 basis points increase, and then see what the data tell us and what next assessment we make on the basis of that data. But let me reassure you, we are determined to fight inflation and return it to 2%. And we will take the measures that are necessary. They will be data dependent, and they will function on the basis of these three parameters that I have just mentioned to illustrate what our reaction function is. You had a second question, which you said was a repeat of previous questions, which I think had to do with any other options, what has happened behind those closed doors, and I fully appreciate the question. I have to tell you that the Executive Board proposed that option which is described in the monetary policy statement, and that no other option was proposed. I can also tell you that the decision was adopted by a very large majority, with 3 or 4 that did not support the decision, not in its principle, because they were ready to go for that decision, but they were keen to probably give a bit more time to see how the situation unfolds and what additional data we can collect. But otherwise, it was a very large majority decision. And I would say taken in rather record time. Thank you.
Thank you, President Lagarde. I would like to now turn to Kolja Ruzio of the German weekly Die Zeit. Kolja, please.
I would like to ask a question concerning the data-driven decisions. Isn't there a conflict of goals between price stability and financial stability? And to what extent do you consider slowing down the pace of rate hikes because of financial stability? Do you have to slower down perhaps because of financial stability? That is my first question. And the second, were you surprised by the financial problems we see now in the US, and we saw last year in the pension funds in the UK? Was this a surprise, or is it something which was expected perhaps by monetary policy experts?
Well, let me be pretty clear on that point as well. I believe that there is no trade-off between price stability and financial stability. And I think that, if anything, with this decision, we are demonstrating this. We are addressing the price stability issue by raising interest rate by 50 basis points, which is what we had intended. And because inflation is projected to remain way above our target and for too long. And separate from that, we also are monitoring market tensions. We stand ready to provide any kind of additional facilities if needed. We do have extensive facilities, more so, by the way, than the Fed in terms of size of the collateral pools and facilities. And we can do more if necessary. We have demonstrated that in the times of PEP. All the instruments that we decided in the PEP times, whether it is on the pool of collaterals, whether it's on the haircuts, whether it's on all issues, that can be reactivated like that. And we always stand ready to use them again. So, euro liquidity is perfectly addressed. No issue on that front. So there's no trade-off. We have to do our job. This is primary objective, price stability. And as I said, in the identification of the three components that will inform our decision, that will determine our reaction function, you find the word financial. If you look carefully, you have assessment of the inflation outlook in light of the incoming economic and financial data. So the financial issues are captured in order to assess inflation. So there is no trade-off. We have financial stability very much as part of our radar screen and the tools that we can deploy, but there is no trade-off between the two. Did you want to add to that, Vice President?
Well, first of all, good afternoon. Well, from a financial stability standpoint, and the perspective is quite clear. If you look at the industry as a whole, as the President has indicated before, the situation of the European banks, they are resilient. Capital is much higher than it was 10, 15 years ago before the global financial crisis. The liquidity position of the European banks is robust. If you look at the liquidity ratios, on average, they are clearly above the minimum requirements and even the pre-pandemic levels. And even if you look at the composition of these liquidity buffers, they are high quality, very high liquidity assets. So in that respect, the composition is quite positive. And finally, there is something that I think that is relevant, is the increase in interest rates, is positive in terms of the margins of the European banks. And this improvement in terms of profitability more than offsets, potential losses in fixed income portfolios. Looking at the exposure, for instance, to Credit Suisse, they are quite limited. And, there is no concentration. There is no a single counterparty that concentrates a large part of that exposure. And finally, as the President has indicated, we have a toolkit of instruments just in case that are needed in order to deliver liquidity.
Thank you, Vice President. And now the next question for Martin Arnold of the Financial Times. Martin, please.
Hello, President Lagarde. Could you just explore a bit more this potential for a trade-off between financial stability and price stability? Could you foresee a situation where, given the outlook for inflation, you need to raise rates further, but there's a risk that that could trigger a financial crisis or make a financial stress worse? Second question is that given that you've said the underlying inflation is going to be one of the key factors you look at when deciding, one of the three key factors, does that mean that until you see an easing of most of the indicators of underlying inflation, which you're not seeing at the moment, you won't be able to stop raising rates? Thank you.
Thank you, Martin, for your questions, the two questions. On the first one, as I said earlier, we don't see any trade-off between price stability and financial stability. And we will address each of these two with their respective instrument. For the moment, interest rate for price stability and the set of facilities that we have available, additional lines if necessary, including in other currencies if that is needed, in order to address financial stability issues. So they inform each other. I'll come to that in a second, but we handle them separately and there is no trade-off between the two. it's pretty obvious when I say that the inflation outlook will be assessed in light of the incoming economic and financial data, that the financial data, whatever they are, will inform our assessment of inflation. So through that assessment, those financial data, we actually take into account development in the financial markets, financing, financial cost, terms and conditions, and the financing of the economy at large. Your second question had to do, if I recall, with my second. Sorry, wait a minute. I need to get back to my second item. Yeah, because you did refer to the key, but it's the second. The first one that we mentioned is the assessment of inflation outlook in light of economic and financial data, and it needs to be confirmed by the underlying component of inflation. And on that front, we are again going to be data dependent. And it is obvious that as long as we see underlying component of inflation going up, this is not going to stop our fight against inflation. So we will need to receive confirmation on the underlying component of inflation. We will need to receive confirmation that we are heading in the direction of our target of 2%. We are seeing some slight improvement in certain areas, but frankly, not a lot. And we know that whether you look at core, which is one of the components of the underlying inflation, or whether we look at, other dissection of inflation, and in particular when we look at services, it's not yet heading in the direction that would confirm the inflation outlook that we have.
Thank you, President. And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for the opportunity. Good afternoon. My question
Good to
is...
see you in real life, not on screen.
Thank you. My question is on the mentioning of monetary policy transmission, which comes in your decisions in the three points that you said about explaining your reaction function. So one of them is the monetary policy transmission, and also at the end of your decisions, you mention that the Governing Council is ready to adapt and adjust your instruments to preserve also the monetary policy transmission. Mm-hmm. So we think about TPI when we hear mm-hmm. about this. Mm-hmm. I'd like to know whether you think that TPI can be used when banking tensions start to jeopardize the transmission of monetary policy, and whether in your fully equipped toolkit you could also consider to adjust the pace of the reduction of the holdings of securities under the asset purchase program, so the QT.
First of all, on monetary policy transmission, I will be giving a speech soon about monetary policy transmission and about the first leg of monetary policy transmission and the second leg of monetary policy transmission. All I can say at this point in time is that we're beginning to see transmission of our monetary policy through the credit channel. And if you look at rates, if you look at terms and conditions, if you look at the impact that it has on the demand of financing on the part of both corporates and households, we are beginning to see transmission of our monetary policy, which is really what we expected. TPI transmission policy instrument was precisely designed to make sure that monetary policy would travel and move all the way to all members of the 20 member states. To all 20 members of the euro area. And that caused by...
All right, everyone. So The tone overall, I would say, was a little bit more on the hawkish side. I will be sharing the link if you want to continue watching the ECB press conference. I'll share the link in our Discord. But overall, kind of reinstating that they are fighting inflation. They are on the path to fighting inflation. They're not losing the battle here. And the goal is to bring inflation back down to 2%. And the Credit Suisse risk is pretty contained within Switzerland and, so to speak, within the banking sector and overall, of course, well liquidated, well capitalized banking sector. So lots to take away. I will be doing a separate video, maybe going over some of the key take points. But if Jerome Powell is even remotely as using a very similar tone to what Christine Lagarde had to say, I think the market might be in for a bit of a rude awakening, considering that we are still pricing in now expected to see 6 rate cuts. 1, 2, 3, 4, 5, 6. 6 rate cuts over the next few months from the market, which is very, very significantly dovish from a monetary policy standpoint. So again, next week is when we have the Fed meeting, March 22nd. And again, I'll be sharing the link for the ECB if you want to continue watching. That's going to be it for today. We've been live for a little over an hour and 30 minutes. So thank you so much for joining in. I really, really appreciate it. And thank you so much for joining in. Make sure that you drop a like, subscribe to the channel. Markets overall slightly lower. AMD is flying though, up over 4%. And we do have Google also pushing higher. So some of big tech pushing higher, but we do still have Meta, Microsoft, Tesla rolling over, and yields are really coming down here. So 10-year yields are now down over 2%, which obviously is benefiting TLT up 1.6, and TMF is up a little bit over 4% as well. So thank you so much for joining. Really appreciate it. Make sure you drop a like, subscribe to the channel if you're joining us for the first time. And the link to our Discord and Patreon is going to be down below. If you want to access all the trade alerts, trade ideas, options alerts, and swing trading alerts as well, link's going to be down below. As always, happy investing. I will see you all in the next